Hi everyone, thanks for tuning in to today's video. Name is Bruce Bradbury and I'm making stock trading and researching and economic videos. But in today's video, I wanted to do something very special. It's gonna be another review video. I found this video online. I listened to the first 15 minutes of it. It's an interview with a stock trader named Mark Douglas from the early 2000s, and it talks all about trading psychology. I listened to the first 8-10 minutes of this video and I was absolutely hooked. I was like, man, this guy has a lot to teach. And I did a little bit of research too about Mark Douglas, the person who is in this interview that we're about to watch. Let me turn in my picture-in-picture. So Mark Douglas, man, sad that Mark isn't in the world anymore because just the way he speaks and the way he presented himself, you'll see. You'll see exactly what I'm talking about. Mark Douglas, the stock trader, although Mark Douglas was also an artist, photographer. Yeah, born and raised in Montana, Mark Douglas has been passionate about art and photography since he can remember. Several of his art pieces have been displayed in museums. He lives in Great Falls, Montana. He died September 2015. Now, I wanted to learn a little bit about Mark Douglas as well because this is one of his most famous books that he wrote in 2000. He is a trading coach, a trading psychologist coach, and I thought this would be relevant because you kind of learn when you read old financial books, or, you know, this one isn't necessarily old, but when you read more books that are dated about trading or about psychology of money or about investing, you realize, hey, it's kind of been the same. It's kind of the same principles. And what I love about what Mark talks about, especially in this video that we're about to watch, is he's talking about the psychology of how to become a consistent trader, right? And this is gonna be an uncut video because I just want it to be pure reaction to what Mark has to say. And we're gonna watch the video together. First, I read the preface of Mark's book, Trading in the Zone. Haven't had time to read the entire book. I just started reading last night, so I just, read the first few pages, the preface, right? But I wanted to take us in. Let's go to the iPad and read. This is from the preface. It all boils down to learning to believe that 1, you don't need to know what's going to happen next to make money. 2, anything can happen. And 3, every moment is unique, meaning every edge and outcome is truly a unique experience. Now, I thought that this was super powerful. That's why I highlighted it. I thought that, as traders, we, talk about the difference between using fundamental analysis and technical analysis. But as someone that's been learning trading, I've been day trading for 9 months now. Right now I'm doing paper trading, so I'm simulating that experience for myself. I'm always hooked because I'm curious, okay, is there a pattern that I should follow or something that I should be doing? Should I be looking into the companies that I'm trading? All of these questions. And I just really like that excerpt. I want to take another excerpt here and look at, I had 5 major objectives in mind when writing Trading in the Zone. 1, to prove to the trader that more or better market analysis is not the solution to his trading difficulties or lack of consistent results. 2, to convince the trader that it's his attitude and state of mind that determine his results. 3, to provide the trader with the specific beliefs and attitudes that are necessary to build a winner's mindset, which means learning how to think in probabilities. 4, to address the many conflicts, contradictions, and paradoxes in thinking that cause the typical trader to assume that he already does think in probabilities when he really doesn't. And 5, to take the trader through a process that integrates this thinking strategy into his mental system at a functional level. Finally, just one more excerpt I want to read. Trading in the Zone presents a serious psychological approach to becoming a consistent winner in your trading. I do not offer a trading system. I am more interested in showing you how to think in the way necessary to become a profitable trader. I assume that you already have your own system, your own edge. You must learn to trust your edge. The edge means there is a higher probability of one outcome than another. The greater your confidence, the easier it will be to execute your trades. I mean, brilliant. Just brilliant. I already love the words and I'm hooked on Mark Douglas. So without further ado, we're going to get into the video. Let me pull it up. I truly am meaning what I'm saying with no cuts. I like to be transparent and, presenting the content in that way. So let us go to put the headphones on and let's start the video now.
Good morning, traders. Thank you for joining us on this WTV special on putting your mind over the market. I'm Jared Levy, Chief Options Strategist here on Wise Trade TV, and using psychology in today's market is not an easy thing to master. It takes a lot of discipline and skill to become a consistent and successful trader. Here to talk to you about what you need to do in order to put your mind over the market is Mark Douglas. Mark has been a successful trader since the 80s and has written 2 books on trading psychology, both Trading in the Zone and The Disciplined Trader. You've heard me talk about them many times here on WTV, and he is here today to help you become successful traders. Mark, good morning. How's it going?
Good morning, Jared. Glad to be here, and I hope I can be of assistance to some of your traders who are viewing right now.
Mark, last time we were together was at Wise Fest, and had a lot of fun. I'm really excited you're here with me today.
Thanks.
So let's get started. First of all, one of the main issues that I see all the time is that people don't use their method to its full potential. In other words, there's a negative correlation between what the trader ends up with and what he could have had if he just followed his methodology. Right. In your DVD program, you refer to this as the profit gap. This is a problem. You refer to it as the profit gap. And I think it's one of the least understood concepts of trading. Can you address this a little bit?
Before Mark addresses it, I just want to chime in a little bit and talk about how that's exactly the experience that I've had trading. I love planning and planning out. I believe if you fail to plan, then you plan to fail. I've planned out, okay, what does it look like for me to try to make 1-2% profit on the day trading? Okay, what does it look like? Well, it looks like this, XYZ, I write out the plan, and then when the trading occurs, maybe my psychology becomes unhinged and I'm not quite sure, I'm not quite sure if I want to stick to the plan. So I try to get creative. Essentially, the experience that I've had is I create the plan, but I don't stick to the plan. It's a very interesting concept because, in trying to get creative, trading is a lot more, probabilistic thinking and not thinking like, oh, I'm going to have a bright idea. I'm going to try to get creative. No, trying to stick to the plan, and that is how it's going to work. So, sorry to interrupt right before Mark began talking, but that just gave me the brilliant idea of you got to stick to the plan. You can't get creative when you're trying to trade. You've got to create the plan and think probabilistically. Okay, let's continue.
This profit gap?
Yeah, that's actually a really good place to start because I think that more than anything, what your viewers want or what your customers want are consistent results. They want to be able to produce an income that that they can rely on from their trading. And I'm sure that many of your viewers have already realized that getting a steady income is not such an easy task.
Yeah, and everyone seems to get trapped thinking that because trading is easy.
Right.
Or because it's easy to find yourself in a winning trade, exactly. Which many people do.
Right.
They think it's also easy to become a consistent winner.
Right.
And it took a long time before it actually dawned on me that winning and being a consistent winner are 2 completely different animals, 2 different things. And in some ways, there isn't even a relationship between the 2.
It almost seems like there's no relationship between the 2.
Yeah.
That's what you're saying, right?
Yeah.
Yeah, that's a real hard mental barrier to break through. Mainly because, it's so easy to find yourself in a winning trade because winning actually requires no skill at all. In other words, unless you consider that the being able to click a mouse button or tap a pad is a skill, right. And we don't have to have a reason or good reason or even actually any reason to put your cursor on the buy or sell button and then immediately find ourselves in a winning trade. And it could be a monster of a winning trade. And what did it take? What kind of skills did it take to actually experience this? Absolutely none.
Yeah. So it'd be natural to take the leap from, well, if it's this easy to win, it can't be that much harder to make a steady income. Like you said, if it's that easy to click the mouse and for me to sit there and make $5,000 or $10,000, then it must be pretty darn easy for me to sit there and make a living out of this. And that's what I thought for a long time, but that is not the case.
No, and that's exactly how I started out too. And I know, not unlike a lot of other people who are willing to, let's say, give up a real high-paying career to be a trader because they thought it couldn't be that hard.
So what makes consistency so challenging? What's the big hurdle there?
Well, we're going to get into that, but at the most general level, I'm going to say that it requires learning the type of skills that people just simply aren't used to learning.
Mental skills.
Mental skills, yeah, exactly. In other words, it requires mental skills. Most people assume that because their technical method gives them a signal to get into a trade, that if the method produces a high percentage of winners, it will equate to a consistent income, not taking into consideration that the proper execution of those signals requires mental skills.
Give us an example of this.
Well, take for an example, a high school basketball player who, he'll go in the gym and practice throwing his free throws, maybe for even 2 or 3 hours a day. It wouldn't be unusual for him to be able to hit 50 in a row, would it? I mean, that's
you
not
see that all the
out of the
time.
realm of reality, right? Okay, so the problem is that could he even hit 2 in a row if the circumstances were he was in the final game of the NCAA championship, his team is down 1 point, there's only a few seconds left on the clock, and he was just fouled.
Changes everything.
Yeah, under those circumstances, without the appropriate mental skills, hitting either one of those free throws is very unlikely. And regardless of how well someone could do it in practice, most people would choke.
So really the skills you're referring to, what you're talking about, Mark, is actually staying focused on the process, staying positively focused on the process itself, in this case, of throwing the ball, in our case, obviously, of trading or following your method,
right,
and not being worried about blowing it, about the consequences of what could happen if this trade goes wrong.
Exactly right. Just like what I'm going through right now.
Here
trying
on
to stay
TV.
focused. Yeah, trying to stay focused on the process of this presentation and not blowing it.
Well, you're doing fantastic, by the way.
Anyway, with trading, we may have a technical method telling us what to do and giving us the potential to generate consistent results. But like the basketball player, without developing the appropriate mental skills, it's unlikely we'll be able to do what our method, our trading plan is indicating without making a number of potential execution errors. In other words, to stay positively focused on the process of trading by doing exactly what we need to do, when we need to do it, without hesitation, reservation, or fear.
Okay. That's interesting.
So you see, no matter how good a technical method is at generating winning trades, turning those winners into a consistent income requires the ability to do or not do some things that the method itself can't help us with.
It's interesting what Mark is talking about here. I'm thinking and putting it in line with currently, today. You see a lot of people online, hey, I've got, this trading system or this strategy that I'm following, or hey, join my Discord group and we can trade alongside each other. I can tell you where to enter and where to sell. But at the end of the day, think about it. Each situation within trading is unique. Patterns, we create patterns through technical analysis. We say, oh, here's the moving average. It's going to bounce off the moving average and it's going to come back down. Or, there's the support, there's the resistance. These types of things are patterns. We're built as humans, pattern recognition beings, right? But stocks don't have to follow patterns. Mark tells us in the book that we just read, Trading in the Zone, a little bit of the preface, that each situation is unique. So if you frame it like that, then you consider that, okay, I'm not going to become a successful trader by just following the system or just doing XYZ, because you have to develop the mental acuity to be able to flip in a dime and understand that each situation is unique, right? You're not just working in a clean-cut environment. Everything is changing. Everything is moving all the time. So that's what I'm trying to get. That's what I'm trying to get across, and that's what I've been thinking about while listening up to this point. It's developing the mental acuity, the skill set, the confidence, and also the ability to execute and flip on a dime on your techniques or your strategies when you see this unique situation pop up. And along with the consistency, okay? Think about it. Would it be easier to say, okay, I'm going to spend an entire month trying to find one trade, one really solid trade, where I make $20,000? Or is it easier to say, okay, every day I'm going to trade in the market. I'm going to see what the market presents me, and I'm going to try to make $1,000 every day. Still ends up being 20,000. But Mark has me thinking that, okay, each situation is unique, so that means that you have to hunt for the opportunity. So perhaps hunting for that opportunity and doing that one $20,000 trade per month might be a little easier than doing $20,000 trades in a month, right? I'm thinking that the opportunities that are afforded to you in every unique situation. So very interesting what Mark and Jared are talking about so far. Let's continue.
Our method can't force us to predefine the risk of getting into a trade. Or if we do predefine the risk, our method can't force us to take the loss that ends up turning into a bigger loss.
Right.
And you know, that's happened to everybody. Okay? Our method can't prevent us from moving a stop closer to our entry point where we get stopped out and the market trades back in our favor. Our method can't prevent us from hesitating and getting in too late. Or our method can't stop us from jumping the gun and getting in too soon, where the signal to actually get in never really develops. And our method can't stop us from getting out of a winning trade too soon and leave money on the table. Nor can it prevent us from letting a winning trade turn into a losing trade without having taken any profit.
I know that all of our traders have experienced these issues. I know they have, and I think really what you're saying is that the methodology, and this methodology, folks, what we're talking about when we say the word methodology is the Wise Trade software, that's our method. And it can give us winning trades. We've seen, I know all of you have had winning trades, but it cannot give us consistent results if we're susceptible to making the kind of mental errors that you're talking about here. Okay?
Exactly right. Yeah, that's exactly what I'm saying. And all the mental errors I just listed are the result of thinking, a result of thinking, believing, or assuming that our technical method is telling us what's going to happen next on a trade-by-trade basis, and not understanding that technical methods aren't designed to do that. Technical methods and patterns are designed to put the odds of success in our favor over a series of trades. It may not seem like it on the surface, but there's some profound psychological implications here. What this means is the outcome of the signals generated by any technical method on a trade-by-trade basis are unique and random. In other words, there's no way to know in advance what the outcome to any particular signal will be or what the sequence of wins or losses will be over a series of trades.
It's a mouthful. and I understand what you're saying. And I think, you know, we need to, first of all, know that many of our viewers out there are experiencing the same sort of thing, okay? And they're probably going to have some trouble grasping this concept that by accepting the randomness of these outcomes, they can produce consistent results. That's an odd concept.
Yeah, but that's exactly what I'm saying, Jared. I know it's somewhat of a paradox to think that events that have a random outcome can produce a consistent result, but think about it. This is the principle that's been used by casinos for hundreds of years.
Right.
Technical methods and patterns will give the individual trader the same kind of advantage the casino has over the individual player, if the trader can think about it from the proper perspective. On the other hand, if a trader who has generated his signal from a technical method hasn't learned to integrate this principle, this randomness principle, into his trading regimen, he'll undoubtedly find that trading can be one of the most frustrating, if not exasperating, endeavors he's ever chosen to undertake.
You know, and I know there are a lot of viewers out there who may be experiencing frustration. In fact, I know there are definitely viewers who are experiencing frustration, but I'm not sure if they're making the connection that the reason because, you know, they don't believe in this randomness principle where you can generate consistent returns by looking at the outcomes of their trades as random and unique. Right. They have to be able to view that as random and unique. You know, that's, I think, the big issue.
No, I know.
I'll give an example. When I was trading a few months ago, I watched a video by a great YouTuber, Umar Ashraf, who is a wonderful trader, and he's got a ton of different patterns that he talks about. He's actually the guy that created TradeZella, that platform that we use on our other videos. I really like the platform. But anyway, there was this video by Umar, and he was talking about how he likes to use this one strategy called the gap, hold, and go. So when the market gaps up overnight, you know, through the pre-market hours, and it holds in the beginning of the pre-market. So it holds from like it gaps up from the night before to the morning when it's trading on the, you know, the other sectors of the world, basically. And then from like 5 a.m. to 6:30 a.m., it's pretty much holding steady, right? And then the premise of that strategy is, okay, we gapped, we hold, and then we go at 6:30 a.m., bam, stock shoots up. So I was like, wow, this is crazy. What an amazing strategy. I'm going to do this tomorrow. So I bought NASDAQ because NASDAQ gapped up. I believe, okay, let's call it 2%. NASDAQ gapped up in the pre-market, and then it held from that period of 5 a.m. to 6:30 a.m. pretty consistently. And then at 6:30 a.m., I expected it to go up because I was following the gap, hold, and go strategy. And I had seen results in the past. I had seen, historical examples of this exact thing playing out. But that's not what played out for me. It was a gap, hold, and it was a dud. The market ended up going way down that day. And I said, no. I'm holding because I saw this video by Umar that told me that the gap, hold, and go strategy, it's going to work out. So I kept holding, and I ended up losing, I don't know, let's say 3-4% on that trade. Because I said, hey, there's a strategy. I'm seeing historical examples of it working. I'm going to go into it full-blown tomorrow. I'm going to trust the strategy, not change my opinion by looking at the market or the order flow or how the market is working and not looking at other companies. I'm just going to trust that this strategy, because I've seen examples of it happening correctly in the past, hands off. And it ended up didn't working out for my favor. Now, no blame on Umar, obviously. Blame on myself because this is exactly what Mark and Jared are talking about right here in this segment. Look, you have strategies and you've planned so far, so much that you feel like, okay, I've understood this. But at the end of the day, when you get there and you follow the plan to a T, it might not prove a profitable system for you because every unique market instance is random. That's very powerful. All right, let's go back.
And that's why we're here explaining it right now. You see, the frustration comes from our expectations. It's from expecting something from our technical method it just can't do. Technical methods define and identify patterns in collective human behavior. Right. Now, the patterns definitely exist. They repeat themselves over and over again. The problem is the outcomes don't always correspond with the patterns on a trade-by-trade basis. So what I'm saying is that, yes, we have patterns, yes, and they repeat themselves over and over, and our minds just naturally think, well, I have a pattern that's consistent, I should have an outcome that's consistent with the pattern, right. And that's not what I'm saying at all. What I'm saying is that there doesn't have to be a relationship between the outcome and the pattern.
Right. So, and if the last trade was a winner,
right.
This trade, even if the charts are the same,
right.
Even if we've got the same exact signal, the same looking chart, there's no guarantee that this trade is going to be the exact same as the past one.
Exactly. In other words, this trade, the trade I'm in right now, could turn out to be a winner. And does that mean that the next trade's going to be a winner? Absolutely not. This trade I'm in right now could end up being a loser. And does that mean that the next trade is going to be a loser? No, absolutely not.
Yeah. This is interesting. I mean, I'm trying to... For us up here, the goal, the main goal is obviously to take these concepts and reduce them down to the most simple of terms. So, let's again back up here for a second. There are traders out there using WiseTrade every single day. They're getting the same exact patterns, okay? But what you're saying is even though the specific criteria is being used to identify the pattern, okay, for each signal, same criteria, same formula, same everything.
Right. The chart pattern can look exactly the same. Everything.
Right. The outcomes to each signal have no relationship to one another.
That's right. That's exactly what I'm saying. That there's a random distribution between wins and losses over any sequence of trades that you might look at. And so, and again, this is a very difficult concept to grasp, but it's really the traders who have grasped it, let's say, and learn how to think in what I call probabilities. Okay. They're the ones that don't experience the same kind of emotional trauma that the typical trader does because they're expecting something that just may not happen. So, for an example, if this trade's a winner based on this particular trade I'm in right now, based on the exact same criteria that or let's say I'm in a trade right now, or I'm getting into a trade right now, and the exact same criteria exists in the market that did the last time, I'm going to naturally expect it to be a winner if it was a winner the last time. Or I probably will naturally expect it to be a loser if it was a loser maybe the last time, or we had 2 or 3 losers in a row.
And this could be a source of frustration for traders.
Oh, absolutely. In other words, and that's exactly what happens. It is a source of frustration, because if I'm expecting it to be a winner and it turns out to be a loser, I'm going to be frustrated. Not only going to be frustrated, I'm going to be disappointed, and I may even feel betrayed, depending on how much kind of energy that I put into the idea that the trade is going to be right.
Well, how do we get over that? I mean, how does a trader take, okay, so I've done all the things right. I've got my charts lined up. I've done everything I was supposed to do. How does the trader at least begin to accept these sorts of things, or how do they begin to remedy these issues?
Well, we kind of have to get into the nuts and bolts of this, of just exactly how the markets work, because I think that one of the big problems, one of the reasons why people have such a difficult time with this, is because their initial exposure to the markets themselves is through electronics. Right. In other words, through electronics, there's a real disconnect between what you're actually participating in and what's causing you to want to participate in the first place. In other words, markets started as exchanges, right. And there were and so when you traded at an exchange, so you know that all prices are people-generated events.
Correct.
They are, and see, this is what people have to take into consideration. Everything happens because of what people believe. When you look at the nature of trading and break it down to its simplest components, what you have is everyone trying to do the same thing. There is no possible way that any of us can make money as traders unless we can buy low and sell high, or sell high and buy low.
Correct.
Is there any other way, Jared?
No.
No other way.
In every market.
In every market. So basically, everyone's trying to do the same thing, are they not?
Yes.
Everyone is doing the same things. Now, the reason why we have price movement is because everyone has a different idea about what is high and what is low. Okay?
Right.
So now I get exposed to a technical method. Now, what does this technical method do? And this is the relationship that people need to grasp. If they grasp this relationship, then they can grasp this idea that you can take the same set of criteria and end up with random results. And it's this. It's like what people realized years ago is that you can take data points. In other words, data points meaning what you're doing is you're translating the human behavior, the human belief in if I'm going to buy
into something visual.
What's that? No, it doesn't have to be visual, but it's like it could be. Yeah, it started out being visual. It started out being chart patterns based on bar charts. But what you do is that if I'm going to buy, it's because right now, let's say the last price is 10, and I put in an order to buy something at 10, okay? It's because I believe that the market's going to go to 11, correct, or it's going to go to 12. Right. Certainly if I thought or I believed it was going to go to 9, I would wait, would I not?
Correct.
So the reason why I'm buying at 10 is because that's what I believe. In other words, all price movement is based on people's belief about what's going to happen in the future.
Now you said to me in a conversation we had yesterday, obviously we as individual traders are not large enough in our accounts to move the market.
Exactly. And
okay.
So this is the next connection that people have to make, is that since all price movement is based on people's conviction or belief about the future, how do prices actually move? For an example, when you put in an order or I put in an order, I don't trade at a level where I can actually move prices. But what the typical screen-based trader doesn't understand is that there are thousands of traders out there who do move prices, and that it is their intention to move prices. Or you can have a large group of traders coming into the market and then cause prices to move. But what actually has to happen for prices to move is that if the last price of something is 10, for the market to actually move to 11, all the offers have to be taken out, meaning that, or move to 12, all the offers at 11 have to be taken out. So in other words, people who are trying to sell at 11, they have to get their orders filled before it can get to 12. Okay. Well, for someone to actually bid it to 11 or bid it to 12, they are doing the exact opposite, and this is really critical. They are doing the exact opposite in that moment of what it takes to be successful. Okay. They're not buying low, they're buying high. They're buying high relative to the last price. Or buying higher relative to the last price.
So how does understanding this concept? How does understanding what moves the markets help our traders to take it to the next level? How does, I mean, is this the first step for them getting control and understanding how the markets work and getting a grasp
they
of it?
definitely have to understand. They have to understand how prices move, because when they understand how prices move, then they'll understand how their technical method relates to this movement. Because what technical methods do, whether it's a visual pattern or moving averages or any wise trade or whatever, you're using mathematical formulas. Okay? You're taking data points. In other words, you're taking what people believe about the future, transforming them or transposing them into a data point. As a price over time, okay, or with volume. There's any
or a
number.
Fresh cross.
Yeah, there's any number. That's what it ends up being, is a fresh cross. But I'm talking about the actual mathematical formula that makes the fresh cross. Okay. So there are any number of variables that go into this equation. Now, what people have found is that, and this is here. What people have found is that using these data points into certain types of mathematical equations, you can find patterns in collective human behavior. And what these patterns mean is this: is that when this set of criteria, okay, is present in the market, that there is simply a higher probability than not. In other words, there's a higher probability, or what I'm going to call an edge, a higher probability of one thing happening over another, that other people are actually going to come into the market and bid it higher from here or offer it lower from here. There's just, in other words, when the pattern is present, this collective pattern is present, it will repeat itself. But the problem is that it repeats itself on a random basis, because even though the actual mathematical criteria is exactly correct or exactly the same.
Mathematical models can't predict human beings.
That's right. Mathematical models can't predict who the actual individuals who are going to come into the market and actually do it. In other words, it takes someone to do it. When you put on a trade, if you're not going to make your trade a winner by bidding the market, if you bought something by bidding the market,
using all of my money.
Using all your money if you bought something at 10, you could actually wipe out all the offers and bid it to 11 or bid it to 12 or bid it to 13. Now, if the price is at 13, all the trades that you put on at 10 are winners, right?
Yeah, but I still bought it at 11 and 12.
Yeah, but you're averaging up. But the point is, all the trades that you put on were winners. You actually made yourself a winner.
That's correct.
But what I'm saying is that when you don't trade at that level, we are actually obliged to other traders to come in to buy something at a worse price than what we thought was low to make us winners.
So what you're saying is most of us out there are dependent upon someone else to move the market for us. We're trying to identify that pattern, obviously using the Wise Trade software to find those common entries. But again, it's a random event. But we're putting the edge, you said, in our favor.
Yeah. Jared, when you put...
You got to ask the question, and I wrote it down here, will people come into the market and bid the price higher, or will they ask it lower? A big trading problem that I've had is I'm always eager to get into the trade. Okay, I put in a limit order to buy at 10. But the price is moving up and up and up and up and fast. And I begin feeling, YOLO. I begin feeling, okay, I really got to get into this. So I move my limit order up to $10.10. It doesn't fill. I move it to $10.20. It still doesn't fill. Finally, I switch my limit order over to a market order to fill it whatever price, is available. The stock fills at $10.30. It ends up being $10.35 was the peak of that price movement in that area. Basically, the perspective is, okay, you have to think about, are you buying at a good price? When you're buying, will people come into the market to bid it higher? Or when you go into the market, will people begin starting to ask it lower? Usually when I try to follow the buy, when I try to follow the price action with my orders, and I hesitate initially, I end up missing the movement, right? Because I'm just trying to say, oh, I care more about buying in at whatever price. And that's a bad move, I think, that I've made on my part in the past. I say, oh, I want to buy in at any price because I just want to be in. But not considering, okay, when I buy, will people bid it higher? Or will people come in to ask it lower? So what's going to happen to the stock price, to the movement? I've got to consider the buy is just as important as the sell. So I don't want to just buy into something and hope that it goes either way. I want to have conviction at the beginning when I buy that stock that I'm buying at the beginning of the price movement, or when I purchase, that there's a lot more room for that price to grow. That's very interesting what Mark is telling us here.
on a trade, okay, when you put on a trade, do you know who, now what we've done is we've reduced the market down to these terms, okay, that it takes someone else to make us a winner, right?
Correct.
Okay, when you put on a trade, do you think about who that might be, who might come into the market to actually make you a winner?
No, of course not.
Yeah, no. And if it turns out to be a winning trade, do you know who those traders were or who that trader was that actually made you a winner?
No.
Is there any way to know?
No.
There might be, but it'd be pretty hard to find out, right? I mean, you could go to the clearing firm, you know, the firm that clears the
bottom line is
bottom line. Yeah, exactly. So what I'm saying is that when the pattern presents itself, like, okay, I have an edge here. When the pattern presents itself, we don't have any idea of who is actually going to come into the market to do this for us. And so there's no point in analyzing. There's no point in judging. There's no point in trying to figure out whether it's going to work or not. It would be like, for an example, if I said to you, Jared, I'm going to give you a coin, and this coin is weighted in a way where it's going to come up heads 70% of the time.
Right.
Now, just because I know mathematically and statistically that this pattern of coming up heads 70% of the time exists, is there still any way for me to know the actual sequence to heads to tails?
Of course not. It's an infinite.
Well, no, I'm saying, do I know the sequence? In other words, I'm going to flip the coin 100 times, and statistically it's going to come up heads 70% of the times. I still don't know which
times
flips are going
to come up heads.
Which flips are going to come up heads. They say which flips. It's not the times. Right. Which ones? In other words, we flip the coin once, it comes up heads. Flip the coin twice, it comes up heads. The next one's tails, the next one's tails, the next one's tails. In other words, we could have streaks of heads or tails, okay? We could have...
I really like that. That's a very interesting perspective, not considering, okay, what's the probability that I win this exact trade? I'm taking this one trade right now. What's the probability that I win or lose? Well, I don't really know. The point that Mark is trying to make here is, okay, expand it out. Tell yourself, okay, over 100 trades, I want to give myself a 70% probability that 70% of them will be winners, right? So I don't know where each trade will go, but I can set up my trading strategy. I can set up my risk management. I can set up, following the patterns, but then letting it ride from there in a way that guarantees, or at least, attempts to guarantee, that I will have more winners and losers in the long run. So, interesting perspective, because instead of just on every single trade say, hey, I'm going to try to make this a winner, kind of understanding and internalizing, well, I'm getting into a trade, it might not work out, because I don't really know, the market is random. It could act in this pattern as, but maybe that could be just my human brain trying to identify and perform some pattern recognition on a truly unique scenario. But what I can do is, I can have great risk management. So I can cut my losers off quickly. I can, follow the pattern and try to find an edge, try to find an ability for me to, boost that probability in my favor over the long run. So that if, my average win on a trade is $100 and my average loss on a trade is $50, but then my edge is contributing to the probability so that in the long run, 70% of my trades are winners and not losers, then over the long run, I'm actually, performing that probabilistic analysis and creating the success for myself, even though I don't know what's going to happen in that one in that one unique scenario. Very interesting to conceptualize it like that.
We could have streaks in there. The point that I'm making is that there is no way to know the actual sequence.
But at the end of the day, we know we have 70%.
So what that does, that obligates us, if we want to be able to trade our methodology in an effective fashion, to be able to utilize this methodology in a way where we can extract the maximum amount of profit that it makes available to us based on the pattern that it identifies. We have to do it in certain ways. In other words, our mind has to be free to be able to execute these trades without making trading errors. And the trading errors come from believing that because the pattern is present, that it's going to give me a winning trade on this one. This trade is going to be a winner.
You can't think that way.
No, you can't think that way.
You can't think that
That's the way the typical trader thinks.
Right.
The typical trader thinks, I'm not going to put this trade on unless I think it's going to be a winner. Or why would I do it? And it skews our expectations. See, it messes our expectations
Let's back up a couple seconds here. There's some great stuff here, Mark, and I hope our traders are getting all of this. You're basically saying, and this makes a whole lot of sense to me, and I hope it's getting through to you guys, we have a tool that gives us an edge. Whatever it is. Right. Even if that edge is 2% or 3%, I don't know if we can...
No, it's more than that.
Maybe more than that.
What do you mean more than that? It's a lot more than that. It's far more than 50%.
Well, I was saying greater than 50. Okay. I was using edge is defined as...
Yeah. Okay.
So maybe 55 or 56% of the time.
Right.
Let's just say...
And the thing is, it doesn't even have to be 50% to actually make consistent money. That's what people can realize, too. That depending on what the ratio is between what you have to risk to find out if a trade is going to work and how much profit it generates when it does, you don't even need a 50% win-loss ratio. Right. As a matter of fact, back in the 80s, there are, one of the most famous traders from the 80s, Richard Dennis, on a percentage basis, 95% of his trades were losers. 95%. But the 5% that were winners were monsters. And he was able to put on trades at a 95% loss ratio and make, at the most at one point, I think around 1987 or 1988, he had $400 million.
Is that...
Wow, so there are actually two concepts that we're dealing with here. We're talking about win-loss percentage, okay? What is the percentage of trades that are winners versus what percentage of trades are losers? But then there's also, win-loss ratio in terms of how much money you make on each trade and how much money you lose on each trade, right? I want to separate and parse out those two things. If my average winning trade I make $100 and my average losing trade I make $50, then mathematically I can make twice the amount of losing trades than winning trades and I still break even, right? So if my amount of money win is much, much higher, then that's another way that I can structure the probabilities in my favor. And that's what I really like about saying to myself, hey, my trading goal for a winning trade is to make at least 1%. But my stop loss per trade is 0.5%. So that's a 2-to-1 ratio. I'm stacking it in my favor a little bit to give me a little bit of an edge, I guess I would say, on, okay, I can make more losing trades than winning trades. The probabilities are there. So that's the two separate things that I want to parse out. The probability, the ratio between, how many you lose and how many you win. And also the probability between when you win, how much do you win? And when you lose, how much do you lose? If you keep your losses small, then it kind of grants you more domain to make more guesses and to basically have more times that you're wrong. Now, yeah, that seems truly powerful if you're able to capture both. If you're able to lose small when you lose, and you're also to lose less frequently. Very interesting, very interesting. All right, let's get back to it.
Using his edge or his money management or a combination of both?
A combination of all of it.
Okay.
And see, one of the things he did too, and this is something I ought to really qualify with, he would use orders to actually probe the market. See, there's one of the things, I don't want to leave what we're doing right now, but I'm going to just kind of divert just for a moment, okay, and so that people understand that one of the first things to be a successful trader that you have to learn, other than the fact of finding a good edge, meaning something that puts a pattern, a collective pattern that your edge identifies, that puts the odds in your favor, right, that there's a higher probability of one thing happening over another once this pattern is present in the market, is that you have to learn how to think in probabilities. In other words, you have to get your expectations aligned with the way the market actually exists. Right. And when you do, in other words, when you learn these kind of mental skills and you're able to execute your trades without fear and without hesitation, without analyzing, or even without thinking for that matter, because you don't need to think. I'll give you an example. A professional trader, what a professional trader thinks about when there's an edge present is, does he think about whether the edge is going to work? Absolutely not. Because he knows, he has learned there's no point. Right. There's no point in analyzing or judging or building a case for or against whether that trade is going to work, because he understands the human component. Okay, right. But what he does think about is he thinks about the risk. How much do I have to risk? How far am I going to let the market go against this position to tell me that other traders are either going to come into the market and make me a winner or not? And he also has a plan for how he's going to take profits.
Right. Wow, that is very interesting. Mark, I'm thinking of when I put on trades, when I enter into a trade, I'm looking at the screen, my hand is on the mouse, I'm thinking, okay, I think I'm about to enter. I think the pattern is working out for me. I feel fear in my heart. I feel fear that, oh, what if it doesn't work out? What am I going to have to do? Am I going to have to alter the strategy if it doesn't work out? And what Mark is telling us is, hey, that is the wrong way to think. Do not get creative. Success is simple, and you've got to think probabilistically. Okay? Not even fearing, knowing that, saying, hey, I understand and I accept that this trade might be a loser, but I'm still going to take the trade. I feel that. Whenever I take on a trade, I feel a little bit of fear. If it's a larger trade, I feel more and more fear. So that's a very good psychological marker for myself that I'm not at that point yet. I'm not thinking that way. I'm not thinking probabilistically, because in the back of my mind, I'm thinking, oh, wow, what if it doesn't work out? If it doesn't work out, I'm going to have to change my strategy here. I'm going to have to try something new. But no, Mark tells us, hey, no. Follow the plan, follow the system, make the probabilities work in your favor instead of trying to act creatively. You're a machine. In today's day and age, we're trading against huge companies. We're trading against whales. We're trading against people that move stocks. We're trading against computer programs that trade on no emotion. Honestly, if you think that you're going to read a news report and you're going to, oh, wow, the news report, that indicates that this pattern is going to form, and then you buy in and then you try to sell out, okay, maybe it works out, but you don't think that the computer program that's trading, at one of these hedge funds has already done that milliseconds after the news is released. You have to assume that that's what's happening. You have to assume.
And he also has a plan for how he's going to take profits.
Right.
But the typical trader, what does the typical trader do?
They don't have a plan.
Well,
or they think about the trade too much. They think about, is this going to be a winner? Is this going to be a loser for me?
The exact opposite of the professional.
So what the professional does is basically...
And then once they make up their mind that it's a winning trade, they don't predefine their risk, do they?
Right.
And they also don't have a plan to take profits because they think when
it's going to be a winner.
It's going to go on forever.
And I want to talk about that. We're running up on the break here, but I want to talk about that on the other side. But what you're saying is the bottom line is the professional sees the entry. He sees the pattern, whatever it is, the edge, enters in, not thinking if I'm going to win or I'm going to lose, but has a money management strategy in place, knows exactly how much he wants to win or is willing to win and how much he's willing to lose or risk.
Right.
Exactly. Now, does he put a cap on the upside? Does he put a cap on his win side?
It's not a matter of a cap. It's a matter of how, his assessment of how much potential there is. Okay. In other words, see, the problem is on a winning trade, we're obligated in a sense to make these never-ending decisions as to what the risk to reward ratio is. In other words, as the market's going in my favor, what's the risk of finding out that it's going to go further? And that's why so many professional traders or people who teach trading advocate scaling out of positions.
Right. Mark, this is all great stuff. We're going to have to wind it up. We got to go to a break, guys. It's already time. As I said, for a break. We'll be back with much more with Mark Douglas here in 3 minutes. We'll see you soon here on WTV.
Well, everyone, thank you. As they're going to break, I'm going to call it a break too. Tune in to the next part of this series in the next few days, and we're going to be looking at and watching the rest of this video. Really appreciate you tuning in, and I learned a lot from Mark here. Let me just go over some of my notes before we close out on the segment that I was taking while watching the video. Doesn't have to be a relationship between the probability and the outcome, meaning that everything is happening uniquely, right? You can trace a pattern in the market. You can say, oh, here's the moving average, and it's going to bounce off the moving average over here, but it doesn't have to do that. So you have to understand that that outcome is not guaranteed because the market is unique. Frame trades as random events. Know that a pattern may form, but expect that the stock will perform uniquely. If you have that expectation already in your head, you're not going to be surprised when, oh wow, it didn't bounce off the moving average, it went straight through. Because it doesn't have to follow the pattern. Learn to think in probabilities, learn to think probabilistically. Price movement is based on people's belief about the future of price. Large traders or group of traders can move the market. Think about that. You're a little fish in a big ocean. You're a little fish in a big ocean. And next, ask the question, will people come into the market and bid it higher? Or will they ask the price lower? Will people come to the market and bid it higher, or will they ask it lower? You have to ask. I've been in many trades where I try to chase the price. I try to chase the buy. And then by the time I've actually caught the buy, it's too late. The price movement has already happened, and I end up in a losing position. That was very important. Use orders to probe the market. Now, I'm not quite sure what Mark didn't elaborate on that, but I also took the note there because, I'm not quite sure. That's an interesting question that I have, and we'll probably have an answer by the end of the next video, by the end of this interview with Mark. Think in probabilities once again. Define your take profit mark and define stop loss mark. Now, Jared asked the interesting question, do you cap your upside? Do you say, okay, I made 3% on the trade, I'm done, I'm selling out. What if the trade runs another 3%? I don't know. What do you do in that situation? And that is why Mark talked about how a lot of people talk about scaling out of the position. Okay, if it hits 3%, take profit, sell half. And then, define another point. If it goes up another percent, sell half of that. And now you're 75% out of the position. You've made your money, but you're keeping that little 25% of your position just in case something crazy happens. I think that's a nice move. That's a nice move. I can think of in my own trading, I've practiced scaling into a position. I'm not quite sure if that is a good strategy. I've not practiced scaling out of position as much. I try to sell, bam, I sold. I'm out of the position. So that's just a few insights that I had from today's video. Well, everyone, thank you so much for watching today's video, and I appreciate it. Please leave a comment, subscribe, like, and hit that notification bell to know when the next part of this video interview is going to release. Okay, thank you so much, and I appreciate your time. Have a good one.